Yo, we're gonna get started, everybody.
Let's pull this together, everybody. Find a seat. We'll have just a little bit of introduction before I dive into the material for tonight. So thanks, everyone, for coming out to Atlanta BitPlebs. We got some first timers, so you guys are most welcome. Make sure to have a beer if you'd like. And we usually have snacks, but our snack master is in the great state of New York at the moment, so we're a little lacking on the snacks. Typically, we'll go for somewhere between an hour and 2 hours, and then after this, we often go get some food and beers and stuff at a nearby place here on the Beltline. So we'll kind of figure that out after the session for those who want to stick around. So this is Atlanta BitPlebs. We are a group that talks about Bitcoin. We actually spun off from Atlanta BitDevs, hence the kind of rhyming name. So the BitDevs group is the technical group, and it's mostly about people that are interested in working on Bitcoin protocol, Bitcoin wallets, and understanding the protocol of Bitcoin on a code level. At BitPlebs, we focus more on Bitcoin as money, Bitcoin financial topics, and sort of the revolution that Bitcoin is bringing about in terms of the way that we all understand the financial world to work. So my name is Doug. I sometimes am also known as Elwood or Hodl Barbarian because it's just fun to have a secret identity that's not really secret. And I guess a little bit about me. I'm actually a little bit of a coder, but I'm mostly a finance guy. So I am a chartered financial analyst, which is, I guess, means I'm qualified to help you with your finances, but I'm not here to do that tonight. So this is not financial advice. This is just me presenting some ideas. Also, I work for a company here in town called Intercontinental Exchange. We operate a big trading platform. We own the New York Stock Exchange. Nothing I'm saying here tonight has anything to do with my employer. And then I'm a quant, which means I am trained to do sort of mathy financial things, which we'll do a little bit of tonight. So that's kind of about me. I think that's probably it. In terms of upcoming stuff, next week we'll have a session on buying Bitcoin privately with Bitisk, led by Jordan. We'll be in the same room, and then 2 weeks out, we'll be at a local watering hole called Manuel's Tavern, and we'll be having a premiere of a new Bitcoin movie called Stranded at Manuel's Tavern, and we may also cover the last chapter of Soft War, which we've been going through, or the last section, or we may not bundle those two together. We haven't quite decided yet. So that's kind of the upcoming stuff that we're doing. Steve, anything else you want to shill or throw in?
I'll say that Stranded is a movie about Bitcoin mining utilizing stranded energy. So if you're interested in Bitcoin mining, it's a cool movie to check out. And then for the rest of November and December, we'll have weekend hacker jam sessions going on here at ATL BitLab because there's a Lightning Network hackathon going on called Legends of Lightning Volume 2. So if you want to come out and just learn to get involved, you don't need to be an expert programmer. You don't even need to be a programmer at all. If you just want to be able to say, hey, I want to help out with a cool Bitcoin project, we'll help you find a team and you can come collaborate. Ida's been helping us out with stuff. She's not a programmer. She's been product managing for us. Lipsy's not here. She's been helping us out with stuff. Got a lot of people here around the community who've been participating in all these projects, regardless of like whether you're a programmer, designer, product manager, all that kind of stuff. So if you want to kind of get involved in Bitcoin at a more deeper level, then come out to one of our jam sessions.
And if you're a programmer and you are not very experienced, even if you are a very, very beginner, that also helps. We have for everyone.
Awesome.
Show's complete.
All right, we'll dive in. Probably maybe do some introductions of who's new and whatnot after the fact. Maybe in the after hour session. So we'll go ahead and dive in. This week, this session kind of came up a little randomly. We've been covering a book called Soft War by Jason Lowery, but the guy who was supposed to cover this third and final section of it ended up having a work-related event tonight pop up. So I said, okay, well, what can we do to fill in? I'll sometimes fill in with current topics on Bitcoin and so forth. But tonight, instead of diving into like just the news cycle and what's going on, we'll talk about that sort of peripherally. I wanted to refresh some quantitative analysis that I had done on investing in Bitcoin. I actually originally put this material together for TabConf 2021, where I presented it in the beginner's room to a group of people that were interested in Bitcoin investing then. But of course, we were in a different phase of the market back in 2021. We were, closing on all-time highs, and now we've been through a bear cycle. And as we'll talk about, I think we're on our way back up from the bear cycle. There may be others who have a different opinion of where we are. But anyway, so I've refreshed the numbers, and we'll talk about kind of what they mean and how to interpret them. But for starters, we're going to just talk about this sort of slide title page here. So I took this hodler's cheat sheet from, there's a guy named The Rational Root who has a website called the Bitcoin Strategy Platform. It's a pay website, but I pay to be a member of it. So I figure I have the right to steal his stuff and throw it in my slides. So what he does here is this spiral graph is cool. It basically, if you start at the very center and you sort of spiral outward, that's the passage of time. So maybe to just kind of talk it out there, we have each of these sort of quarter wedges is a year. A complete rotation around the circle is 4 years, which approximates a Bitcoin halving. So what we do is we start here in the middle. Now, what does the middle versus outward mean? The further you are toward the edge, the higher the Bitcoin price. So when you're in the middle, Bitcoin is worth nothing. As you get further up the edge, the Bitcoin price is going up. So what we have here is a picture of the entire history of all the Bitcoin cycles and their price on one piece, on one page. It starts in the middle, and then this is the very early days of Bitcoin, where we have some very noisy hash rate. We've got random people if they turn on one more laptop, right, it moves the bar and that kind of thing. And then we make our way around, and then eventually, the hash rate sort of starts to become more of a stable, upward and to the right sort of thing. But what we have here is the early cycles of Bitcoin, and what you can see is there are these concentric circles where we're spiraling outward. And the idea is Bitcoin is forever spiraling outward in its price pattern. You can see that at no point, even all the crashes and ups and downs of Bitcoin, never has the spiral touched, the one before. So what that means is, these two spirals are going to be 4 years apart. So even though Bitcoin has gone up and crashed and done all sorts of things, by the time you get to 4 years later, it could be kind of close maybe visually, although they're not as close as you think, because this graph here is not linear, it's logarithmic. So meaning what we have here is we go from a penny to a dime to $1 to $10 to 100 to 1,000 to 100,000 or to 10,000, 100,000, a million, and so forth. So even though these two look pretty close, one of them is where we are today, 35,000. The other's like 8 or 10,000. So they're not as close as they look. And the fun part about the graph here is what we have is, because Bitcoin follows this sort of predictable 4-year cycle, which is anchored on the halving, we end up having a predictable sort of emotional roller coaster that goes with the 4-year cycles. And so you can see we are, according to Root's graph, we are now in a period called stagnation, leading into actually a period called disbelief, which we've just moved into. So what does that mean? Well, the stagnation period was Bitcoin's doing nothing, everyone's bored with it, the price isn't going anywhere, and now lately it's just been, it's kind of moved up, right? We got out of the 20,000s, we blew through 30,000, we're at 35, pushing 36 last I checked earlier tonight. So, we're in this disbelief phase. We've got, I'm sure some in this room are saying, oh man, this is a sucker's rally, it's going back down again. We've got others in the room who are going to say, oh no man, this is where it's headed, right? Because we're going to go from there to doubt, to hope, to the calm before the storm, then optimism. And so what'll happen is this wedge here will be 2024. This point right here will be the halving in 2024, where the issuance of Bitcoin will go from 900 Bitcoin a day to 450 Bitcoin a day. And then we'll go, around. And then typically it's this wedge here, which will be 2025, where we typically have a lot of all-time highs. And then we typically have a big crash as we get down here, and it all starts over again. Now, will this go on forever? Who knows? We've got less than 15 years of history on Bitcoin. So that means, we've got very limited number of these cycles to draw inference from. What we've seen is, hey, it looks like this happens every time, but 3 or 4 times is not statistically significant. So when we talk about these things as if they're a known fact and a done deal, that's probably, you have to take that to some degree with a grain of salt. We can suppose what we think is going to happen, And there's always the opportunity for crazy things like COVID, right? Which you can see on the graph right here. You can see things are trucking along. The colors, by the way, correspond to reddish colors, mean people are basically at a loss with their Bitcoin. And then the greenish colors mean people are making money. So you can see what was happening is things were moving along nicely. We were in the kind of, some people were making money, and then COVID hit and it just crashed down in the red. Now the crash is kind of small on the graph, but because this is a logarithmic graph, like I said, a small move like that is tens of thousands of dollars. So that was COVID, and you can see we recovered very quickly, and then we went, in 2020 back into what followed, which was the last bull market. So you can kind of see that sort of stuff in here.
And then so if the lines were to touch, it would mean the price is the same as it was in the previous cycle.
It would mean the price is the same as it was 4 years prior in the previous cycle, which has not yet happened, but it may happen someday, right? So, who knows? So, we can't say that just because
that would be awesome to stack.
It would be good for stacking. So anyway, this graph is, it's called the hodler's cheat sheet, psychology of a market cycle. And for fun, it's a way to orient yourself on where we are, in the cycle. This is at least where Root, the rational Root, he spoke recently at Bitcoin Amsterdam, and he's a pretty smart guy. This is where he thinks we are. Another way to look at it is like this. Where are we in the Bitcoin cycle? Well, 70K. I'm an idiot. Why didn't I buy Bitcoin at 30K? You are here, 30K, maybe 35. Lol, I ain't buying that shit. That's where we are. So. All right, so that's the fun stuff to get us started. Now we're going to talk about what we're really doing here. So what is this presentation about?
Charts and graphs.
Throughout its almost 15-year history, Bitcoin has primarily been adopted by cypherpunks, libertarians, technologists, and retail investors. I think we probably got that group well represented in this room. In this discussion, we will seek to understand why Bitcoin might become an increasingly attractive investment asset for institutional investors. Now, you might say, why do we care about institutional investors here at Atlanta BitPlebs? Because that's probably not us for the most part, even though I do work for a big financial institution. Well, the reason why is the ability to front run Wall Street is a rare opportunity to achieve financial freedom, and you don't want to miss it, in my opinion, not financial advice. All right, so let's talk a little bit about these numbers, because there's a lot of different types of people that throw around, sort of mathy types of numbers around finance. So we're going to talk about technical analysis versus quant finance and draw some distinctions between what these two things are. So technical analysis seeks to identify a market trend, utilizes fairly simple ideas like moving averages of the market price, encourages investors to wait for confirmation of the trend, and really the best case for technical analysis is to help investors follow the market sentiment. You want to be aware of, is the market trending up? Is the market trending down? And you want to sort of try to follow that. It's more useful for short-term tactical moves than long-term investing, in my opinion. I know we have some technical analysis wizards in the room, so feel free to take umbrage with my characterization of your preferred discipline, if you like. Seeks to time the market. Quantitative finance, on the other hand, this seeks to apply more sophisticated mathematics and statistics to understand optimal asset allocation and portfolio construction. Institutional investors will often employ these techniques. They've got, we're talking about PhDs and people with fancy degrees from Ivy League schools and people with lots and lots of computers and, tremendous databases and all that sort of stuff. These are the guys that I work with, some of them at my company, and a lot of them work for hedge funds and whatnot. So we've got those guys, and they're generally, for the most part, not seeking to time the market. And when I say these institutional investors, what I mean these are pension funds, right? These are, endowments. They have huge pools of money, and what they're looking to do is say, okay, we should be in this asset class, this percent, that asset class, that percent, that asset class, that percent, always evergreen until we change our mind. They're going to write it in an investment policy. They're going to put it on a shelf, and it's not going to change for a decade. And that's the way these institutional guys invest. So they don't care so much about, do we get in, this week or next week or this month or next month. They're just trying to do a set it and forget it kind of policy around how they want to be allocated to assets broadly. So they're really more interested in long-term strategic shifts than they are in short-term tactical moves. Ideas change slowly. Like I said, they put it on the shelf for a decade, but they tend to be very significant when they happen. All right.
So that one is more like a DCA.
So they will typically rebalance their investments. So what'll happen is maybe they are supposed to be, we'll talk in a minute about 60% stocks, 40% bonds, which is a classic sort of retirement portfolio allocation. So what'll happen is if your stocks do well, you might get to 70% stocks and 30% bonds because your stocks ran up. Then what you're supposed to do is rebalance. So you sell some stocks, buy some bonds, and get back to the 60-40.
And in order to do that, they don't use technical analysis in those cases?
They typically do not use technical analysis. They just rebalance whenever things move. So basically the idea is we always want to be on our strategy. This is the way like an institutional portfolio manager will run a portfolio. I used to do this for a living too. So I'll have my policy and it says you should be 60% stocks, 40% bonds. Well, stocks go up, bonds go down, or bonds stay the same. You have too much stocks. So you sell stocks, you buy bonds. Why do you do that? Because that's what the policy says, and if you don't do what the policy says, you can get fired. So as a investment professional, you pretty much want to just follow the policy and do that stuff. You're not really caring about, oh, I want to wait because I think stocks are going to go up more and I can get a better price or that kind of thing. You just sort of follow the policy, and the idea is more, whoever made the decision to pick this asset allocation is, they're the ones who get to make that decision. What I'm doing is just trying to execute on it. This is the way a lot of these things work.
One more thing, though, when you're talking about the policy, we're talking about the policy that fund or that company did, or a policy that is coming from the SEC or some other institution.
It's typically a policy that company adopted. Now, they may have a consultant. A lot of these guys hire investment consultants. The consultants come in and they have recommendations, they have meetings. But in the end, they've got an investment board, and they sit around and debate things. And then, they're often very slow to change. They're very risk averse. These policymakers are really more worried about losing their seat on the board of directors than they are anything else. So, this is why we've got nearly 15 years of history of Bitcoin outperforming, and they have not adopted Bitcoin yet. But we're getting close to the point where,
because the board holds them back from taking on risk.
That's right, because they're very risk averse, and they started out with the opinion that, oh, this is a scam, or it's a tulip bulbs, it's a bubble, whatever it is. So it takes a lot of history, and they have to be wrong for a pretty long time before they go, oh shit, we were wrong for a really long time. And then suddenly, there'll be some thought leaders, some of the big institutional investors, the Stanley Druckenmillers and the Paul Tudor Joneses, or some of the big hedge fund managers that have, at times embraced Bitcoin. That sort of all happened in the last cycle. Now we've got BlackRock coming in with ETFs, or at least trying to. We'll see whether the SEC allows it. Fidelity has been a long time beating the drum on Bitcoin. So a lot of the big financial companies are starting to warm up and say, hey, this is something we want to get behind. And so that's sort of the way that these investment policies start to change. Okay, and then let's talk about one more school of mathy things that you can do, which is mining the blockchain for data, or on-chain analysis. On-chain analysis, this is something that's specific to Bitcoin and other crypto assets. We have a public ledger, right, that is auditable by anyone for Bitcoin, and it's true of, I guess, most of the crypto assets out there. They have their own version of it. So you can actually read that data in and then run it through some heuristics and algorithms, and try to extract from that some useful information. And we'll look at some of that as we get later in the presentation as well. But you're seeking to identify trends based on which cohorts are transacting, right? You're looking for things like, is it the fast and loose money that's buying, who's selling, that kind of thing. And it can also be useful in identifying bull and bear cycles. All right, so we got that out of the way. So let's look at a little graph here. So we've got a $1,000 investment. Green means you put it into stocks. Blue means you put it into bonds. You made this investment on September 17th, 2014. Why did you make it on that date? Because that's the first date that Yahoo Finance has Bitcoin price history. So Bitcoin existed before that. You could make the argument that maybe the price history before that was, a little bit more dubious, or I don't know, maybe Yahoo just doesn't have it. But we know that Bitcoin was trading like $300-400 at this time. We know there's Bitcoin price history going back to when it was like a dime and $1 and stuff like that. But we've excluded that period, so we're starting for this whole presentation with the period of time where Bitcoin was trading around $300-400, which is in September 2014.
Yeah, also just to be clear, this is saying you buy and hold for the entire duration. This is not like buy and sell after a year.
Correct. This is you bought stocks and you held them. So you put $1,000 into stocks and you've held it all the way through yesterday, I believe. So you can see for stocks, we're going to get, looks like we were over 2,500. We fell back below. We're back over 2,500. We fell back below again. Maybe we're barely above. I can't tell. The interesting thing is,
Hey, Doug.
Yeah, go ahead.
Is that the SPY? Like, what are we?
Yeah, that is the SPY. I'm going to cover that in just a minute. Good question. Well, I'm starting out saying stocks and bonds, and then I'll give you the specifics. But here's one interesting point I wanted to point out. See that little thing? Long-term treasury bonds are down since September 17, 2014, and that's including coupons. So basically, if you put your money in long-term treasuries, almost 10 years ago, you're actually still at a loss, if you held it in this is TLT.
So what happens in 2019, almost 20, that the bonds were more than the stocks? It was that
that's
a
COVID
specific
right here,
event?
Yeah, this is COVID crash right here.
Oh, okay. But
COVID,
COVID
so
wasn't
stocks
20,
spiked
right?
way down and then recovered quickly. Bonds,
but that's
fared
true.
better. Yeah.
Okay.
Okay, cool. So stocks versus bonds. Good question we just got asked. Stocks, we're using SPY. Bonds, we're using TLT. What are these things? SPY, the original S&P 500 ETF. The Spider S&P 500 ETF Trust, SPY, gives investors cost-efficient, highly liquid exposure to the S&P 500 index, providing access to 500 of the largest publicly traded U.S. firms, managed by State Street. TLT, iShares 20-plus year Treasury Bonds ETF. iShares 20-plus year bond ETF seeks to track the investment results of an index composed of U.S. Treasury bonds with remaining maturities greater than 20 years, managed by BlackRock. Okay, so why do we pick those two things? They're benchmarks. We're going to get into the 60-40 portfolio, and the sort of prototypical 60-40 portfolio was broad U.S. equities, which is probably best epitomized by the S&P 500. And then long treasury bonds are usually the best kind of partner with them because they are all government. There's no credit involved. Credit is a little more like equities. And then they typically have good diversification benefits with the equities. So we'll talk about that. Yeah, Alex.
For the bonds, would other I don't want to call it expiring bonds, like if you had like a shorter, like 5 or 10 years, would it also be a similar shape of the graph, or is it only like the long-term ones that are performing?
So the longer term the bonds, the more they will respond to changes in interest rates. So basically, longer bonds are sensitive to rates going up and rates going down to a greater degree than shorter bonds. And so I'm using the long bonds here because what you're trying to do is longer bonds also will typically give you more return than shorter bonds. And so over a long period of time, well, not this long period of time, but generally over a long period of time, you would expect the longer bonds to perform better. But what we've seen is for almost the last 10 years, they're down because, and that's really driven by, you can see what's happened here over the last 2.5, 3 years. But yeah, generally speaking, what you want to do is have a portfolio that's well hedged, and the hedge of the long bonds, which are all treasury and have what we call duration, is typically sort of a different risk than the stocks risk. And so the idea is when stocks go down, bonds go up, and when bonds go down, stocks go up, and that has worked quite well up until recently. So there was a sort of a 40-year period where this portfolio, the 60-40 you're about to talk about, worked like a charm. As it turns out, that 40-year period coincided with a massive period of interest rate declines. Because if you go back to like the 1970s, when we last had a serious inflation, we had a different Fed chairman named Paul Volcker who raised the Fed funds rate up to like 20% or something, 19%. and that caused interest rates to go way up. And then after that, Volcker is sort of renowned for having tamed inflation in the 70s, and we had a 40 plus year period where interest rates just declined and declined and declined and declined, and that's extremely good for bonds. So that's why we had a great bond run for most of my lifetime, probably everyone's lifetime in this room.
So then, question about the bonds, just because. So let's say let's start in 2014, just to get an idea, because what were the long bond yield compared to the short term bond yield? Like let's say around those days for people to go to buy long term bonds.
Yeah, so there's this idea called the yield curve. The yield curve typically in a healthy period of time is upward sloping. So you're going to get less yield for shorter bonds and you're going to get more yield for longer bonds. That changes when there is fears of a recession. And actually, then you get what's called an inverted yield curve. We actually have one right now. We've had it for the last year. So the short-term bonds are, 5%, and the long-term bonds are like 4.5 or something like that at the moment. So that's a yield curve inversion, and that typically is sort of a doom signal, right? It means there's a recession coming on, and people are scared. And so this is why you've been hearing probably in the news, if you follow this stuff, that there's a recession that's imminent because the yield curve has been inverted now for probably about a year. And interestingly enough, the recession has not yet manifested, at least not in a big and meaningful way. We definitely see some signs of strain, but we haven't had a full-on recession yet. So it remains to be seen, are we going to have that recession in 2024? We're going to skip it this time. The yield curve inversion has been a very reliable predictor of recessions in the past, but there's some make the argument that this time's different, right? And that's sort of the joke is that's always the most dangerous words in finance. This time is different.
So I guess just a specific question is, I've never really bought bonds because at my age, not trying to buy bonds.
Right.
But most recently, when I'm looking at bonds, it's a yield inverted bond market.
Right.
So let's say just in previous cycles before this, what's like a typical between 2014 and 2017? What's a typical long to short term bond yield difference?
So the yield curve has moved all around, in the time. Off the top of my head, I couldn't tell you what the yield curve's shape was, in a specific year. We can go out in Yahoo Finance and look it up if we want. But like I said, when back in the 1970s, the short term was 20%. So the long term was probably also in the ballpark 20%. I don't think it went to 30 or 40%. But whereas what's happened over the ensuing multiple decades is it's come down. And so in recent years, we've had cases where short-term bonds were at number of basis points, right? You'd have
the Fed funds rate is the short term.
The Fed funds rate anchors the short-term bonds rate. So there'll be a quarter of a basis point or 50, half of a percent basically. And that's the one thing the Fed really controls is the short end of the yield curve. The Fed doesn't control the longer end of the yield curve nearly so well. So what they can do is they control the short end because they'll set a policy rate saying we're setting the Fed funds rate to 4 point whatever percent it is or something, now 5%, and then they can enforce that by going out into markets and printing money and buying bonds or selling bonds and whatever they need to do to sort of force that short-term rate to be at their policy set rate. And then the rest of the yield curve, the longer part, will kind of take its signal from that and follow suit. But it may actually say, if there's worries about a recession, that it may actually go down from there. And if people think, no, we're looking at inflation or we're just looking at good times ahead, then it will typically go up. Okay. All right, so we did all this before. Let's keep going. All right, so we mentioned this already, the 60% stock, 40% bonds portfolio. This is sort of your mom and pop's, retirement allocation. Like I said, it served them well right up until really just after the COVID crash. Since COVID, this thing has been a disaster, which we'll talk about. But long considered the gold standard, no pun intended, for asset allocation. It performed admirably for decades, right up until COVID. Stocks typically provided higher returns, but were more volatile. Long treasury bonds provided lower returns on average, but tended to do well when stocks did poorly. So what you want when you're constructing a portfolio is diversification. Now, why do you want diversification? Well, this is sort of one of the underpinnings of the whole field of quant finance. But the basic idea is it's really good if when you have a portfolio where you have assets that are not very correlated to each other. Because what you don't want is everything to crash at the same time. Maybe it feels good when everything's mooning at the same time, but the problem is you're setting yourself up for everything to crash at the same time. So you're better off, and there's a whole lot of math behind it, which I'm only going to talk about in vague sense, but there's a whole lot of thought behind why it's really good to have uncorrelated or even negatively correlated assets comprise your portfolio. And that's why the stock 60% SPY, 40% long treasury has been so good for, again, prior to the most recent time periods. Because generally speaking, when stocks are crashing, long treasuries are going up. And that's that you get that negative correlation, which is to your benefit. The diversified portfolio benefit from an era of decreasing interest rates and increasing money supply. We're talking about that.
So in this kind of portfolio, the 60% stock is normally like a more like S&P 500, or they normally use to have more volatile stocks. Because even in the stocks, there are some that are more volatile than
That's
others,
right. So when you own the S&P 500, you own a mix, right? And we're going to talk a little bit about what's been going on this year in the S&P. And then, what you don't get are a lot of smaller cap and mid cap stocks. And so there's other sort of more sophisticated indices of stocks, which give you what's called the total U.S. stock market. And then you can also say, well, maybe I don't want to own only U.S. stocks. Maybe I want to own the total world stock market. So we're using this as sort of a shortcut. There's all sorts of variations on this. Either way you can do. Maybe you want to own the NASDAQ. Maybe you want to own, mid caps. But in general, things that we're going to say about 60% S&P 500 and 40% long treasury bonds are going to be roughly true about more or less any mix of stocks and bonds that are, an average proportion. Yeah, typically the NASDAQs are a little more volatile with a little more return. There are periods of time where the tech stocks do things that are different than the rest of the stocks. But actually, if you graph them, they're still pretty highly correlated, all stocks together. So this is sort of why it's, and I think, a lot of people maybe have their money in something like a 401k plan where, they don't have a lot of options. So they have to pick something like an S&P 500 index and a bond index, and that's what they get. So, okay. So now we threw the gray line in there in between the two. This is our 60% stocks, 40% bonds portfolio. And you can see, as you might expect, it performed somewhere between the two. Again, same time frame. We invested in September 17th, put in $1,000. You can see, though, that one interesting thing is the gray line was pretty damn close to the green line through most of this period. Right up until this point where it starts to break off, because you can see the bonds have just been getting their ass kicked, in the time since COVID. And so now you can see that the 60% stocks, 40% bonds portfolio started to pretty meaningfully and measurably and significantly underperform stocks only. Whereas in the past, you could get like almost the same return, and sometimes even better for periods of time return than stocks by owning stocks and bonds. So this is why you may read online, you may hear people say things like the 60-40 portfolio is dead. And this is kind of why it has not done well, in the last, let's say, 2.5 years.
So Doug, off the top of your head, if you were to extend out the starting point like 30 years, well, do you know what the shape would look like?
So in general, if we backed it up, because I'm only doing this for the period of time that Bitcoin existed, because we're going to obviously get to Bitcoin here in a minute. But yeah, if you were to go backward in time, it looks more like the period before COVID, right? It's the 60% stocks, 40% bonds portfolio has done well for a long time. Now, again, remember, we were in a long, if you go back before the 1970s, then maybe it's a different matter. But ever since the 1970s, when Volcker took interest rates to 20%, basically that was, my whole life, what's happened is the bonds have been doing well because rates have just been coming down, down, and down. And when rates come down, bonds do better. We've had money printing, which means stocks are constantly getting pushed up by more money flowing in. So the 60% stocks, 40% bonds portfolio has had 50 years of doing well up until more recently.
Just the graph makes it look like bonds are horseshit. Why would you ever invest in bonds? They always break your rate line down.
Yeah, so we're going to talk a little bit later about why you might want to pick something that's got lower average returns, but is got beneficial correlation effects to your portfolio. That's the reason why stocks and bonds was such a good mix, is even though the bonds had lower returns most of the time, although you can see actually there's a period here, Alex, where the bonds were ahead, right? They were at the top.
Yeah, I mean,
there.
but like, yeah, like,
But that,
sorry.
go ahead.
You'd expect if people were championing the 60/40 up until a few years ago, the gray line would be far above both of the other lines.
So no, that's not the case because you're.
No, I
It's a
just got it. Yeah, like the gray
You're not
line.
trying to like. There's trying to maximize your return at all costs. That is not the advice that these institutional investors are going to follow, and that's not what If you go to an investment analyst or sit down with a financial planner, they're not going to say this is the portfolio that will chase high returns as aggressively as possible. It has the highest expected return of all, because if you do that, you're also accepting the highest volatility and the highest possible downside. So, if you're going to do that, you YOLO into a basket of altcoins, right, or something. So instead, what prudent investment managers and investment analysts will tell you, and what institutions do, is they want to say, we want the best trade-off of good returns with less volatility. And so that's where correlation effects and where basically diversification comes in. Is what you want to get is the most return you can get, taking on the least volatility you have to take on. So if the only thing you wanted was the most return you can get, you would just go out and buy the most risky thing possible and YOLO. But the problem is, when it goes bad, it goes really bad.
Like, okay, so you're looking for at any point the gray line will never dip too far. Like that's
right. You're trying to get like the closest thing. Again, look at like how the gray line tracks the green line pretty closely up until more recently when bonds has just sort of fallen off a cliff. So there's actually a measure we're going to talk about a little bit later called the Sharpe ratio, which is a more formal way of expressing this concept. So let's kind of get to that, and then you'll better understand what they're trying to accomplish, which is not just trying to be over and above the green line there. Okay, so there you go. 2022 and 2023 have been terrible years for the 60/40 portfolio. All right. So what does this graph look like if we introduce Bitcoin? Let's find out. Okay, so the orange line that you see there is Bitcoin, and where's everything else? It's right here. What the hell is that? Traditional assets have flatlined when graphed against Bitcoin. We're using a standard x-axis here, or standard y-axis here. So x-axis is time, standard y-axis here. So what that means is we're not doing logarithmic scale. And if you ever wonder, why do people in Bitcoin always want to do things on log scale? This is why. If you try to compare Bitcoin to stocks and bonds and you don't use log scale, the stocks and bonds are all flat against the bottom, basically. And you're like, what the hell is that all about? So,
What is the numbers on the left?
the numbers on the left
That's
are
dollars.
That's the
10,
20,000.
20, 30, 40, 50, 60, 69. So again, we put 1,000 in, and if you put 1,000 in on September 17, 2014, at one point you had, if you look at this, you were buying more than one Bitcoin for $1,000 back then. So, you've had, opportunity to have, up there, and then even though with the crash more recently, you're now back 35,000 or so. Okay.
So, it seems like by presenting things on a log scale, we're just kind of throwing a bone to everybody else.
What we're doing is meaning, we're actually throwing a bone to our eyes. Like, you have to kind of understand that, like, okay, if we even want to be able to look at this, the only way to do that is to do it on a log scale. And so what this gets into, though, in my opinion, is what I call exponential versus linear assets. So we appear to be at the precipice of an exponential age. That sounds cool, right? What does that mean? Well, when you have an asset that you can't even graph with traditional assets, they're really not even playing the same game, right? They're not even in the same ballpark. There's something different going on. And if you ever play around with math enough to know, like, what happens when you have an exponential function, a linear function is 2 times x, right? Everything, x goes, up, and 2x goes up twice as much. An exponential function is 2 to the power of x. Well, pretty quickly with x going from like 1 to 2 to 3 to 4 to 5, 2 to the power of x just explodes upward, whereas 2x is still kind of just moving along, you know, at a nice double. So, so we're living now in a period of time where there seem to be a class of assets that have an exponential characteristic to them, and Bitcoin and cryptocurrencies are definitely in that category. There are other things that are in that category too, which we'll talk about. So what does an exponential asset look like? Disruptive technologies. Why is this exponential? Well, if something is going to just completely reshape the world, it's not going to be like marginally overtaking other things. It's going to basically cause the old world to crash and burn and disappear as it sort of explodes upward, right? Game changers, something that's just completely going to, again, reshape the way things work. Paradigm shifts. It's just a different world entirely after this comes along. Okay, so what are you talking about, Doug? What is that like? Well, by their nature, exponential opportunities cannot be well estimated by projecting the past forward in a linear fashion. This is a problem. Humans do not think exponentially very well. As humans, we tend to go, okay, well, what did it do last year? It's probably going to do more or less the same thing this year. Or, you know, what did it do last week? It'll probably do the same thing this week. That's the way our minds are sort of trained to work naturally. And you tend to make the wrong inferences when you're talking about something that's exponential in nature. However, the Wall Street analysts make a great living doing exactly that. They will over and over again try to estimate everything in a linear fashion because that's what their spreadsheets are set up to do. And they don't understand in general that this is a different game until it actually slaps them in the face repeatedly and sort of forces them to either get fired or something significant changes. There's very few analysts on Wall Street who understood Bitcoin for the last 15 years, let's say, and there's very few of them that still understand it. And it's also true of some other things, right? So what are they misunderstanding today? Well, Bitcoin.
So when you're saying they're linear fashion, that means that they are based on past trends, right?
Based on past trends and assuming, well, we'll just kind of continue, but usually they'll kind of take a more conservative view. It's like, okay, well, the narrative now is, well, Bitcoin will probably, go up less in the future than it did in the past because it's probably going to have its returns taper off and tend to be more muted because in the past it was new and and as it's getting bigger and it has a bigger value per Bitcoin, it takes more money to move it. And so they're kind of viewing, okay, well, maybe it had some explosive returns in the past, but they're going to want to project it forward more linearly because that's kind of the way they think about it. Artificial intelligence is another one. Okay, well, how many chips did NVIDIA make last year? Let's just assume they're going to make 10% more next year or whatever. That's why NVIDIA is their favorite AI stock, because they can just count things like how many chips they're making and stuff like that. Whereas maybe the exponential approach to AI is to realize that it's going to change. It's going to, a lot of people who used to have jobs aren't going to have them anymore. People who have, AI systems that can suddenly do the job of 1,000 people, they're going to see an exponential return on the investment of that AI system, right? Because it's going to displace what 1,000 people used to do it. Biotech is another one. There's potential for drugs that can go out and cure entire cancers and things like that. This one is not maybe yet fully manifested, but one of these days we may see an explosion in that area. Electric vehicles, another area where exponential returns seem possible because they're probably going to put most of Detroit out of business. Autonomous robotics, whether it's self-driving cars or robots that can actually do the job of humans and mean that these factories don't have to employ hundreds of thousands of people, also likely have an exponential characteristic to their return. There's more. I mean, we don't know what they all are. If we did, then if you knew one that wasn't on the list here, then you should go buy it and get rich. Hold it. These things can be very volatile, of course, because again, we've got people that believe they're going to just move linearly. So Wall Street's going to generally be telling people, oh, this is overvalued, you shouldn't buy it. And then people who believe, no, it's going to have an exponential characteristic to its future are saying it's undervalued. And there's going to be a big disagreement until one of them's proven right.
Yeah, I mean, this reminds me of like that one quote from Margin Call. Have y'all seen Margin Call?
That was a fucking
Yes.
joke movie.
Yeah. It's
Yes.
like there's like the one scene of like the CEO or the chairman saying,
Oh
you
yeah.
know, there's 3 ways to be successful in this industry: to be first, to be smarter, or to cheat. And while I think, and I don't cheat, and while I think we got some pretty smart people, it's a hell of a lot easier just to be first. Like, I don't know, it's kind of the same vibes. It's like, I mean, the difference between like exponential linear assets are that linear assets actually measure the value of the thing, whereas exponential assets measure adoption and measure people's understanding of the value of the asset.
Right.
Yeah, and what's more, the value of the thing is exploding upward as you realize that
Or the price of
the
it.
old world is just going to fall away and burn because there's a whole new world that's coming about, right? So,
Yeah, I mean, like the quote unquote value of Bitcoin doesn't really change that much because the value proposition doesn't change and people like using it doesn't change that quickly. What
but
changes
as fiat becomes further and further
it
debased,
changes people's understanding of the value, and then that's what causes like the price.
No, I think you're right. There's an adoption curve element to it, like the S curve portion, which is part of the exponential, and then there's also the question of if it's going to reshape the world, right? If we're headed to a world of hyper Bitcoinization, then it is reshaping the world, right? So,
And,
Great point.
Yeah.
So
Definitely.
since 2013 or so, retail investors got on the market a lot more than before, right? Because of apps and whatnot. Has that changed how the market price of stock has changed? Because previously it was driven by Wall Street for the most part. We looked at things linearly, but are we saying, is it possible retail investors tend to look at things more exponentially, and that's kind of played a role in what we've seen in tech?
I think so. One of the interesting things that's happened is not just the apps like the Robinhood or whatever, but social media. The best investment content you can find now is probably available on YouTube, right? It's not coming from these Wall Street guys that they get their fancy educations, they work in these big banks, but the problem is their boss and their boss's boss and their boss's boss's boss are not going to let them come out with some incredibly insane price projection for anything in the future. They're going to go, no, tamp that down. Let's just mark it up 10% and we'll wait and see, right? So that's where these linear things come from. Is you've got the guys who are running the show in these firms, are old and they tend to be anchored on old ways of thinking. And even if the young guys at these Wall Street shops want to say no, you don't get it. This is an exponential thing. They're usually not going to be able to persuade the boss above them and the boss above them. Gina.
So what role do we think that money printing policies by the Fed creates in society potentially an unreasonable expectation of linearity that's essentially fraudulent, right? So making it more difficult for incumbents to fall or collapse if something that is significantly better comes along. I mean, we've often seen that. I mean, is that potentially a role there? Like, do we know how common sudden increases would have been in like the 20s or 30s when you had airplanes coming in and things like Boeing coming into the world and so forth? I mean, surely that's happened in the past.
Yeah, so we've seen in the past, and I didn't throw it in this deck, but there's a good slide with like S curves of disruptive technologies, things like the telephone and the airplane and the light bulb, and they've all basically had this exponential characteristic to them. So it's sort of like, when you have a new technology that's going to be like, there's a picture like here's, New York, and there's like horses everywhere in one car. And then here's the same picture like 5 years later and there's one horse and it's all full of cars, right? So when in 5 years, if you were in the business of, putting horseshoes on horses, you're out of business. And if you're in the business of like changing car tires, you got rich, right? So this is kind of this idea of way big changes like that have an exponential impact. So yeah, you can look back through all the innovations that have occurred, over the last multiple hundred years, and they have this exponential shape. So the question is, we were in a period of time, I'd say through most of my life, where things didn't change that much. And I think when I say we're at the precipice of an exponential age, I think we have finally, we went through a period of time where there was a lot of new technologies that were very hard to figure out and hard to get right. And it seems like a lot of them are all hitting at once. And, and one of the most disruptive of all is, Bitcoin as a monetary technology, in my opinion. So.
But you don't think that now, for example, with Bitcoin and artificial intelligence, we're not at the point like the changing from horse to cars?
Oh, I think we are. That's what I'm saying. That's why I'm saying it's an exponential asset, right? cars were exponential when the whole world was using horses, right? For a period of years. The light bulb was exponential when everyone was using candles, right? For a period of years. So that's where we are now, I think, on these things.
So it sounds like we were saying though, but like it took a long time to get to that point. Like,
Well,
we've been dealing with computers and all this stuff for like many decades. It took a lot of time and like R&D to get to the point where you have Bitcoin, artificial intelligence.
yeah. Well, I mean, like the iPhone was exponential when we, didn't have smartphones,
Yeah.
right? Plain old phones that plugged into the wall and rang, went away, and now everyone uses mobile phones, and then mobile phones went away with smartphones, right? Because smartphones are better than that. There's mobile phones also destroyed all sorts of devices like cameras and GPS, standalone devices and stuff. So we have seen exponential things happen in our lifetimes. A lot of it, we're driven by software and things, but it seems like what ended up happening, I think, was there was the Y2K bubble, the tech bust of the 2000, and I think a lot of Wall Street investors, they went crazy believing everything was going to happen tomorrow, and then it all blew up. And there's actually been like 20 plus years of them now being, oh no, we're not going to fall for that again. And now what's happened is a lot of the technologies that were sort of cooked up in that time of the tech bubble and bust have now matured and are actually going to work better. And yet there's been a sort of tendency to discount them and say, well, we don't want to get overhyped about things. And so now I think they've kind of underhyped certain things. So like AI, I think, is one where, until the ChatGPT moment came, everyone was poo-pooing AI, saying it's not going to happen. Now all of a sudden it's like, okay, well, if you're NVIDIA, you're going to make a lot of microchips. And if you're OpenAI and Microsoft, because you own OpenAI, then your stock gets to go up. But they're still not believing that we have, autonomous robot cars. They're not ready to take credit for that yet, for the most part. So there's pieces of the thing which, until it kind of hits them in the face, they're not going to believe, right? And they're going to continue to do that linear projection.
But where's the market cap gonna come from? I mean, if I think of the world economy, it's valued at like 70 trillion or something like that, or, in that ballpark. For exponential growth, you got to sustain a much larger amount than that to be able to keep seeing it. Where's that going to come from?
Two places. One is you're going to disrupt old industries that are going to die. And so all the market cap from those old industries are going to flow into the new. Mm-hmm. The other thing is you're going to have a much bigger economy, right? One of the things that, my Elon Musk says is when he's one of the things Tesla's working on is an autonomous robot, right? Which he says, the definition of an economy is the number of workers times the productivity of each worker. What happens when your limit on the number of workers is effectively infinite, right? If you can build an autonomous robot that can actually do useful work in a factory or wherever, a la one person, and then you can mass produce those autonomous robots, you suddenly create the potential for an unlimited economy, right? You can build as much as you want of anything because you can have an infinite labor supply. And this is where you get into an interesting question of what the economy of the future might look like, and why people won't take jobs in factories doing manual labor anymore because it won't make sense, right?
We'll just buy our own robots to go to work for us.
Yeah, that's right. if you can afford it, if you invested in the robot before it took your job. All right. So investments in exponential assets are making traditional markets irrelevant. This is a good example. All of the returns within the S&P 500 stock index in 2023 have been generated by just 7 companies, nicknamed the Magnificent Seven. Anybody know who these 7 companies are?
Microsoft,
Okay.
Apple.
All right, we got Alphabet, Google,
Apple,
Amazon.com, Apple,
Microsoft,
Meta Platforms,
Facebook,
Facebook,
Netflix.
Microsoft,
Microsoft,
NVIDIA.
NVIDIA, Tesla. Netflix is out.
Oh.
All of the
What about GameStop, man?
All of the returns. Because the other 493 stocks taken together are flat to down on the line.
Steven, pass me the paper, the towel paper.
So this is what it means if you want to be in the right assets. You don't want to be in the wrong assets. Do you want to own this S&P 500 or do you want to own just your maybe favorites of those 7 and maybe some Bitcoin? So there you go. All right. So now we're going to put Bitcoin and our portfolios on the log scale, right? So we can now say what's the performance of $1,000 over the course of this period of time, and you can see initially, because of where we started out, Bitcoin went through a bear market and went down. And meanwhile, all the traditional investors were laughing and saying, "You idiots! You know, you bought that stupid Bitcoin thing and you lost your shirts." And who's laughing now, right? It's massively overtaken those portfolios. So that's kind of what it looks like on a log scale. Even on a log scale, traditional assets look pathetic. That's the log scale over there. So what does log scale mean for anybody who doesn't know? Instead of this going 1,000, 2,000, 3,000, 4,000, we go $1, $10, $100, $1,000, 10,000, 100,000, a million. So every move up is like exponentially more than the prior move up, basically. And that just allows us to sort of put those things in a picture where the traditional assets are not completely smooched to the bottom, although they're still fairly flat-ish.
Yeah, fuck traditional assets.
There you go. All right, so analyzing return distributions and
Can I ask you,
correlations.
I'm sorry, about log scale, this is kind of random, but what about like a percentage, like those like 100%, 200%, 300%, 400%?
That's still linear, right? It's still, whether it's 1, 2, 3, 4, or 100, 200, 300, 400, it's still linear. So you're going to have the same picture as we saw before.
Okay, cool. Okay, thank you.
All right. So analyzing return distributions and correlations, building better portfolios. This is what these guys are trying to do with. So let's start out by looking at the returns. So what we were graphing before is the value of the portfolio. What I did here was say, I'm just going to extract from each of these time series the daily returns. So like before, the blue daily returns are bonds. They're sort of most centered around zero. We know bonds, have generally less upward side and generally less downside returns. Although you can see, like as you go from the left to the right, the bonds were, more tightly clustered, on the middle and to the left, and then they've kind of become more dispersed out to the right with the dispersal towards the downside. Some of the green is covered up by the blue because the blue is sort of on top, the green's beneath it. So you can see, the stock returns are kind of underneath the bond returns, but you can see they also spread above and below. So the stock returns are just a little more on average and a little less on average daily than the bond returns. Mm-hmm. And then of course the orange is behind all of it because it's more dispersed and spread out, and that's the Bitcoin. And you can see the Bitcoin returns are much higher above and can be much lower below. This is an exponential asset. Bitcoin daily returns seem to be roughly an order of magnitude, which is a 10x, larger than traditional asset returns. So when something is 10 times bigger than something else, you say it's an order of magnitude bigger. And when the return is 10 times bigger, you say it's exponential versus the other asset. All right. So this is kind of what it looks like when we look at the daily returns. So now we're going to talk about Statistics 101, correlation. Those of you who had any statistics probably know about this. Even if you haven't, you probably know intuitively what it means. Here's what it means mathematically. So correlation is expressed with a rho x, y, or core x, y. And what we do here is we take a different thing called the covariance of x and y, and then we divide it by the sigma x, sigma y, which is the standard deviation of the x and y series. Another way to say that is it's the expected value of x minus mu x, where mu is the expected return or the average return of x, and y minus mu y, which is the average return of y. We take the expected value of those two things, multiply by each other, and again divide by sigma x, sigma y. So specifically, what does that look like? Well, this is again using statistical notation. There's the expected. It's also equivalent to the expected value of x times y minus the expected value of x times the expected value of y, all divided by this big thing with the square root here, which is your standard deviations of each. So anyway, this is correlation. Why, all this math is not really that useful. What you can think about is the idea of correlation is it ranges from 1 to -1. Something that has a correlation of 1 moves in lockstep with something else. So if this asset and that asset always move together, they have a correlation of 1. If this asset and that asset always move opposite, they have a correlation of -1. if it's 0, when this guy moves, this guy is completely unpredictable. And when this guy moves, that guy's completely unpredictable. There's no pattern between the two. So 0 means they're uncorrelated, meaning they seem to have nothing to do with each other. A negative correlation means they tend to move opposite each other. And a positive correlation means they tend to move together. So what you want for a good portfolio, to build a diversified portfolio, an investor should seek to hold assets with a low correlation to each other. So low would mean like you don't want everything to have a high correlation to each other, because then you're going to all move at the same time and all crash at the same time. So something like with a correlation of 0.25 is going to be useful to your portfolio more than something with a correlation of 0.95. You want to choose like a really good asset that you like, and then another good asset which has a low correlation to it that you also like. So the best thing that you could do for years and years and years was 60% stocks, 40% bonds. Even though the bonds weren't that great compared to the stocks, they had a low correlation and sometimes even a negative correlation to the stocks. And that diversification effect gave you a beneficial effect to your portfolio, which we'll talk about in a minute. Okay, so let's look at what we have here are rolling 100-day correlations. The purple line is stocks to Bitcoin. So you can see this is a rolling 100-day correlation through time. So again, the correlations are going to range from, this graph is 0, 0.2, 0.4, 0.6, 0.8, and then negative 0.2, negative 0.4. So you can see there are periods of time where stocks and Bitcoin have a negative correlation. When we got into the most recent bull market, you can see it jumped up, and we had a block of time where stocks and Bitcoin had, a very high correlation during the bull market. And why did that happen? Well, during the past bull market, people thought Bitcoin was a tech stock, where they basically, there's a bunch of hedge funds who came into the space and created algorithms that said, every day, if I think it's a risk on day, I'm going to buy Bitcoin, buy all the NASDAQ stocks, buy Solana, buy Ethereum, everything, all at the same time. And then every day that I think it's a risk off day, I'm going to sell all that same shit. And we're just going to run this algo all day long. And that's what they did through the recent bull market. And this forced Bitcoin's correlation up. What happened then was when everything crashed, Bitcoin sort of started to return closer to what it's been in the past, which is very largely uncorrelated with equities, because hedge fund guys all got out of the Bitcoin and crypto markets. They turned off these algos and it went away. And what happened is instead got hodlers, people that are just stacking sats and putting them onto hardware wallets. And so the correlation has just been precipitously falling between Bitcoin and stocks. Meanwhile, you can see stocks and bonds, there's some periods of time where they were correlated together, but lots of periods of time in here where they were negatively correlated. What's happened is, in this period of time where the bonds have been getting crushed, the correlation between bonds and stocks has just been spiking. So not only have bonds been doing bad for your portfolio because they've been declining, they've also become highly correlated to stocks. So you can see that the bonds have become sort of a very useless, bad asset for constructing a portfolio from both the return point of view and also from their correlation point of view.
What happened in like summer of 2016 that made the stocks and bonds be super correlated?
I think it was just a bull market where everything was going up together, which sometimes happens. But I have to go back and pay more attention.
If bonds are going down and stocks are going up, why does that increase their correlation?
Well, when bonds are going, so bear in mind that when you talk about bonds going down, what this picture is showing is the value of your bond portfolio. Now, you can also talk about the level of interest rates. So when interest rates are going down, the value of your bond portfolio is going up. So your correlation is going to be positive when, typically if interest rates are going down, then stocks tend to take off and run, and bonds tend to take off and run. So in a period where rates are falling a lot, everything will do well together.
Okay.
In cases where rates are rising, things can all get crushed together, which is what we saw more recently. And that's what's happening here is the correlation is going up because rates are going up, bonds are getting killed, and stocks are getting killed.
Gotcha.
All right. So correlations between stocks and bonds have been rising while correlations between stocks and Bitcoin are falling. All right, so we get to the question, is Bitcoin a risk-on asset or a risk-off asset? During the 2021 bull and 2022 bear markets, market participants treated Bitcoin like a risk-on asset. Like I was telling you, they were buying and selling it with NASDAQ stocks, leading to a period of high positive correlation with stocks. However, Treasury bonds failing recently in their traditional role as risk-off safe haven assets. So investors could be looking for a new safe haven because they're the one that's been the traditional safe haven. Treasury bonds, at least in the last couple of years, don't seem to be working. The deterioration. So maybe the next question is this just a blip, or is there something more meaningful going on here? So the deterioration of fiscal health of most major sovereigns. Our country is is ballooning our debt, right? And most every other country around the world is doing the same. This may be opening the door to the notion of a neutral, non-governmental asset as this new safe haven. Now, this is early. This may not come to pass. We may get back into another market where people are buying the NASDAQ and Bitcoin all together. That we could go through another phase where they become correlated again. But very interesting recently, where we've got wars breaking out around the world in the Ukraine. We've got this conflict in the Middle East, and we've got our we had no Speaker of the House in the U.S. Congress until recently. We've got a debt ceiling that they only kicked the can down the road a few weeks, and we're still going to have another fiscal cliff coming up. So a lot of things like that are going on, and interestingly, Bitcoin is rallying while other things are not. So it's I think it may yet be early to say that Bitcoin has become a risk-off asset. That's probably not happened yet, but I think interestingly, we have guys like Larry Fink, the head of BlackRock, going on TV, and he's of course touting his soon to be launched up and coming Bitcoin ETF. But he's saying we're seeing a flight to quality when we have unrest around the world. People are moving their money into Bitcoin because they're afraid to be in government bonds now. So if Larry's right, maybe he's right, maybe he's early, but I do think we will get there someday. Personally, I think that when you look at the fundamentals of what Bitcoin is, it is a neutral, non-governmental store of value, and as people start to realize that and wake up to it, it's likely to be moved from being a risk-on asset to a risk-off asset, and that's part of what will give it an exponential characteristic, right? When people say it's no longer just a thing to speculate on to YOLO, it's now the safest thing you can own. The utility value of Bitcoin is going to go through the roof. Yeah.
So I haven't been Bitcoin long enough to know this, but at the beginning of the last bull run, were people saying the same thing?
Well, there's always been a narrative, coming from the cypherpunks, and the Adam Backs of the world, that it was largely discounted, right? What's happened with Bitcoin in most of the prior cycles has been, it's something to YOLO into, right? You're going to buy it and you're going to flip it before it peaks, and you're going to buy a Lambo, right? So we've been through. It was more of that crypto mindset, right? And so it's taken, I think, the evolution of going through FTX and Michael Saylor and all these other things to start to bring about a notion, where people are now starting to really treat Bitcoin more like an institutional grade asset to buy and hold, right? MicroStrategy adopted it as a treasury asset, and so far has not blown up. And maybe they've rounded the corner and are going to be, highly profitable on that deal. Maybe it'll blow up in their face still. Who knows? But that's sort of the narrative, right? Is if it comes to pass that Bitcoin is now viewed as a long-term, institutional grade, safe haven store of value asset, then its utility gets to kind of a whole other level, and that's where I think it has an exponential upside ahead of it beyond just or it's a reason for more adoption, I guess.
I mean, to like what extent do you think that it's that hypothesis is more legitimate now than it was like 2019?
I think that we've made significant progress in that regard. I think actually the FTX debacle, a lot of people said, crypto and Bitcoin are dead for 10 years because of this. And what's actually ended up happening was people actually did the homework and said, if you didn't leave your Bitcoin on an exchange with a centralized third party, you instead withdrew it to a hardware wallet, you came out fine. And I think it really sort of helped hammer home the narrative that it's Bitcoin, not crypto. So in a way, I think that event, along with other ones around Celsius and BlockFi and these others, have started to really make the case that Bitcoin is a safe haven if you self-custody it, right? But yeah, we'll see. I mean, I'm sure the battle's not won yet, right? So there's
also MicroStrategy will always talk about when they adopted Bitcoin versus where it is right now, and it's beating every other asset class, but it still follows the liquidity cycles of the normal market. So,
for sure.
You can say it's correlated because, okay, they raise rates, everything goes down, so Bitcoin, it doesn't rip when stocks are going down. It probably it underperforms on the way down and it overperforms on the way up. But that's just a function of liquidity, and so it'll continue kind of following that progress. But on the ways down, it'll probably make higher lows on the way down, which correlates it, sort of, so to speak.
I mean, that's certainly what we've seen through the cycles. And again, you can't necessarily take the cycles and say, well, we know it's going to be the same way every 4 years in the future forever. But what we've typically seen is when Bitcoin makes some new all-time high, and then we reach the top of the bull market, and then it crashes. It kind of crashes down to something fairly close to the prior all-time high. It may barely go below it, or it may not, and then it stays there, and then it climbs back up to the old all-time high, and then it makes a new all-time high, and then it goes further, and then maybe it crashes back down to the prior all-time high. So if it follows that pattern, we might have another cycle here where we go through 2024, 2025, we go north of 100K, and we go to 200K, who knows, and then it crashes back down to around 69, 70,000, and that's the new bear level, right?
So then, what do you think? Because now I guess one of the first times we're entering a halving, and if the Fed keeps rates where they are right now, or they don't reverse, then we'll see potentially an area where there's not additional liquidity, but there will be a halving.
Mhm.
Yeah, and so there'll be an interesting use case to find out. Now, I personally don't believe the Fed's going to go to keep rates where they are now, because they're bankrupting the country. Our interest cost is costing us more than our military now. I think the Fed is going to be forced to lower rates for several reasons. One is we're going to have some sort of bad event, be it a recession or more bank collapses, or we're just going to be bankrupting our own government. So the rates are going to come down. It's also the other thing to say is the U.S. is not the whole world. A lot of what we're seeing going on in Bitcoin right now is coming from India and China and other places. So the Fed doesn't actually control that, and they have an effect, right? But they're not the whole story.
Hypothetically, though, let's say if rates were to stay the same, what would you think? What would be your best guess that Bitcoin would do after the halving?
Rates for the whole world, or rates just in the U.S.? Like if global liquidity were to stay the
kept
same.
the rates at the exact same as they are right now for the next 12 months, and there's Bitcoin happening. Well, of course there would be.
I think even if they kept the rates the same, they're likely to have to print more dollars. And so it's not just about the level of rates, it's about the level of money printing. Typically, one of the things that Bitcoin is most highly correlated with, if you want to track high correlation, is expansions and contractions in global liquidity. So the question is, do we think the whole world is going to be able to keep the money supply across all the currencies about the same? Do we think it's going to grow, or do we think it's going to shrink? I think there's almost no case where you don't believe the money supply is going to continue to grow, because every country out there has dug themselves into a hole with decades of expanding their own monetary supply where they don't have a way out. And so as long as the monetary supply continues to grow globally, I think Bitcoin will continue to grow regardless of the level of rates. One way that they can, do that is with rates, but that's not the only way.
Yeah, but assuming that just to follow up, assuming that the government doesn't pull a single lever, like in the fantasy world where magically, that they get away with, or that they decide not to pull any of their levers, like printing money or raising interest rates, what would it be then? I think the question is really what extent can you attribute the pumping that comes from halvings to Bitcoin itself versus macro effects?
So I would say one of the biggest threats to Bitcoin, if you believe this is a threat, is what if our government balanced the budget, became fiscally responsible, our Congress started working together, getting things done. We started electing sensible, responsible leaders that didn't make up, lies and stupid stories to tell us and promise everybody up.
In this fantasy world,
yeah. In this fantasy world, where the dollar becomes a stable, sensible asset, that might, take some of the blow off top potential away from Bitcoin, right? So if you think that's likely, then that's a risk. If you think that's never going to happen, then it's not a risk. But I think nonetheless, there's this notion of the halving. So let's talk about that. Let's just say 900 new Bitcoin are created every day. The price is staying around 35K for recent weeks or whatever. So what we know is every day there's 900 new Bitcoin and the price isn't moving. What that means is there's demand in the market equal to 900 Bitcoin a day. We're going to get to the halving and it's going to be 450 Bitcoin a day. Do we think that the demand will get cut in half just because the price got cut, because the issuance and supply got cut in half? Probably not. If there's a demand out there for 900 new Bitcoin every day, because that's keeping the price at parity, and we now are in a world where there's only 450 new ones created, you can say, well, maybe the miners aren't selling, or maybe somebody else is selling, or maybe the government sells their stash. There's going to be noise in there, but over some period of time, if the demand of Bitcoin, let's just say, stays the same, and the supply of Bitcoin gets cut in half, that's going to have a positive influence on price. And what we've seen in the past is not just that, but then when the price starts to move, the demand goes up too, and then it has that sort of compounding exponential on top of itself effect, which creates the massive bull runs in the big cycle.
I guess maybe some of the price rally could be anticipating rate cuts.
Could be.
So, yeah.
Or could be anticipating the halving even, right? Or could be anticipating the ETF.
I think to his point a minute ago, there's a lot going on that's not U.S., even though we're the biggest economy. But I'm thinking of, for example, the Japanese yen has been incredibly weak against the dollar historically, and they are printing money like crazy. Just of last week, I think they printed some big multi-billion-dollar. So you have not, we talk about the U.S. dollar collapsing as like the ultimate in winning, but there's actually all these other currencies of very big economies.
There's a lot
that are falling apart.
Right. The dollar will be the last one to
yes.
hyperinflate, right? We're close to it. Maybe, one of the last ones because it's the world reserve currency. We're going to see Japan is going to get squashed like a bug on the windshield way ahead of the U.S., Canada, Europe, and before all that, a lot of emerging market, Argentina's already there, Nigeria, lots of these countries who've got very weak currencies, they're going to blow up, and then we're going to start to see some of the westernized developed countries like, probably Japan will be, like I said, the first off to walk the plank. Yeah. All right.
I guess what's to say they just can't just keep the rates the same for longer? Because I think a lot of people didn't expect the rates to stay this long for as long as they did. So let's say.
But it's not really about rates, right? It's about the monetary supply. So one of the ways that the Fed has multiple tools at their disposal, right? One of them is interest rates. The other is just flat out printing money. And so, they can keep rates at a certain level.
Is that quantitative easing?
Quantitative easing is where they actually just create more money. And so, the Fed has used different tools at different times, right? So they've used the Fed funds rate, and they've also used quantitative easing and quantitative tightening. Quantitative tightening is when they actually try to reduce the money supply. So they have done some of that, but then what happened was banks started going bankrupt, and then they created a whole new facility for the banks to get liquidity, which sort of undid all the quantitative tightening and then gave a whole bunch more quantitative easing through a new back door. So it's really more about the expansion of the money supply than it is about the level of rates. The level of rates is just one way to play that game.
Okay, so since you put it that way, can they just keep expanding? What if they just keep expanding the money supply?
And Bitcoin keeps going up. That's what's happened for the last, 15 years, and that's what's actually happened. You go look at the website. WTF happened in 1971, I guess, where we went off where Nixon took us off the convertibility of gold at the window. From that point forward, the dollar became untethered from any sort of thing that anchored its value. And if you look at that website, you can see all sorts of graphs have gone haywire, and that's what's created this expanding monetary supply, and it's what's created all the inflation we've seen, and it's what's powering Bitcoin now. All right, let's keep moving. Wars and increasing geopolitical turmoil may further push investors in the direction of a non-sovereign safety asset. All right, so now we're going to do quantitative finance 101, the Sharpe ratio, which I mentioned earlier. So the Sharpe ratio is this thing. S is the expected value of a return minus the risk-free return divided by the standard deviation of the returns. Can also be expressed in these ways. Now, what is this thing? In finance, the Sharpe ratio measures the performance of an investment. A higher Sharpe ratio is considered better, and 1.0 is seen as a threshold to beat. So the idea here is it is a question of, for the amount of volatility you're taking on, how much return are you getting to the upside? So what you want is you only want to take on more volatility if you're getting rewarded with more return. And what's more, you want an efficient balance of those things, right? You don't want to take on an infinitely volatile asset to get a little more return. You want to take on a little bit of volatility and get a lot more return. So this is what the Sharpe ratio measures. And when you're constructing a portfolio, a good portfolio manager is trying to give you, one way to optimize the portfolio is to optimize Sharpe ratio. Now, there's about 20 other things that are similar concepts in quantitative finance. Perhaps Sharpe ratio, named after some Professor Sharpe, is the most famous one, but there's a bunch of others. So we're going to use this one in today's presentation. Now, this is not the only way to go about it. Maybe instead you're going to say, you know what, I don't care how much volatility I take on, I just want the most return. Or you may have a different approach to say, you know what, I can't stand any volatility because I'm living on a fixed income and I have to have a really, really, really stable, portfolio, and I want to take on no volatility at all, even if that means my returns are low to none. So different people have different risk tolerances and risk thresholds, and that's kind of the way to think about that stuff. All right, so now we have rolling 200-day return Sharpe ratios for green for stocks, blue for bonds, orange for Bitcoin. So you can see, the bond Sharpe ratios are often below zero here, and we know that over the total period of time, bonds have been down over this period of time. So guess what we're going to find for the Sharpe ratio for bonds? Stocks, you can see, spend periods of time where the Sharpe ratio is above 1, above 2, touching 3, and then coming back down, to 0 and below, and so forth. So for an individual asset, you can kind of say, well, what's the Sharpe ratio of this asset over this period of time? Now you can kind of just go like, draw a line around here. It's somewhere around, there maybe. And then Bitcoin, you can see, has got big periods of time where the Sharpe ratio is above 1, it's above 2, it's above 3, it's above 4, and it's got periods of time where it crashes down here to -2, and so forth. So if we take so this is the rolling Sharpe ratios. Now if we just say, okay, well, what is it over the whole period of time? Well, here they are. So stocks are 0.61, bonds are -0.2, and Bitcoin is a little over 1.02. So Bitcoin all by itself has a Sharpe ratio of 1. Which is very impressive, right? Even for the level of volatility, we know Bitcoin is an incredibly volatile asset. Because its return is exponentially better than everything else, even with the level of volatility you've taken on, a metric like Sharpe ratio still rewards you with overall Bitcoin and Sharpe ratio of 1. Now, by the way, when I last did this calculation, we were about here, back in the bull market. I said in TabConf 2021, there the Sharpe ratio was well above 1, because we were at a moment in time where we hadn't had this big crash. So, Bitcoin Sharpe ratio will look really good at peaks in markets, and probably will look worse, when we were at the depths of the bear, right? It would have been below 1.
Quick question. To what extent is an aggressive Sharpe ratio a function of just picking the correct starting time?
It shouldn't be, because, you can extend this out over, the rolling Sharpe ratios, of course, are, right? Because it's a rolling 200-day period. And so it's like, well, whatever starting time you pick changes that. But as you extend it over like a 15-year period, what you're looking at there is to some degree more stable. Now, you're right in the sense that this particular 15-year period for bonds, the Sharpe ratio is negative. That wouldn't have been the case, you roll it back a long period of time. And especially if you looked at the Sharpe ratio of bonds from like 1970 to 2020, they would look great because we were in a 40-year run of just rates going down, 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 and down, and bonds just looking amazing, right? So bonds, had a much better looking Sharpe ratio in that period. So there is an element of that to it, but it's more about, I would say, since the Sharpe ratio, you're typically looking at a longer period of time. It's less about like selection bias and more about something that I call a regime shift, right? Where you reach a point where bonds hit 0 and then start going back up. Well, we're now in a new regime for bonds, right? Where after a 40-year decline in bond rates, where they looked amazing, now we're looking at a period where they look like crap. Now, who knows? Maybe it reverses and they go back down again, but maybe they don't. Maybe they go higher and further, up, or stay higher for longer. How else would say? All right. So that's Sharpe ratios. Bonds have a negative Sharpe ratio this entire period, which is absolutely awful. All right. So we're now going to introduce a new gold standard portfolio, perhaps. The 75% stock, 25% Bitcoin portfolio. Where did I come up with this crazy thing? Well, I took the numbers and said which one would make would make it look the best from a Sharpe ratio standpoint, and it was pretty close to 75-25. So we went with that. So 75% stock, 25% Bitcoin portfolio has some unique characteristics. Tremendously better Sharpe ratio and performance than 60% stocks, 40% bonds over our time horizon. Better Sharpe ratio than Bitcoin alone. It avoids exposure to potentially deteriorating sovereign debt bonds. You can be sure that institutional investors are performing the same analysis that I'm performing here.
LOL autocorrect.
What's that?
I said LOL autocorrect.
Yeah, it looks like I did get law corrected. Instructional into the institution. Portfolios of this type, if adopted, will lead to substantial allocations to spot Bitcoin ETF products. I would not be looking to buy, or sell the news of an ETF launch for this reason. So let's look at it. So here we have $1,000 investment. We're going to compare the 60% stock, 40% bonds portfolio, which is down there in the gray, to the 75% stock, 25% Bitcoin portfolio. Now, what you'll notice here is I did not have to go to log scale because we're still mostly stocks here, only 25% Bitcoin. And we're comparing that to mostly stocks and 40% bonds. So we are able to squeeze them on the same graph, but you can see the 75 stock, 25 Bitcoin portfolio absolutely destroys in terms of overall returns during this period. By the way, it's worth mentioning this is rebalanced daily. So every single day, no matter what happens, you are rebalancing to 75 stock, 25 Bitcoin. Wow. And likewise, same thing for 60-40. Now, can you do that as a dude who's just like, got your Robinhood account? Probably not. But if you're an institutional investor trying to stay on strategy, you've got a team of people, a bunch of computers, and they make this happen every day. That's kind of how they earn their money.
So 75-25 was literally the optimum. Any 30% Bitcoin was actually worse
from a Sharpe ratio perspective. Yeah. So now investment advisors will start by recommending a much smaller allocation to Bitcoin, probably 1 to 5%. And what they can do with that is go, well, let's look at what adding 1% Bitcoin does to your stock portfolio. And they're going to go, wow, the Sharpe ratio is just so much better by adding just a little bit of Bitcoin. Maybe we should add in 2, maybe we should add in 3. But they'll kind of say, well, we've got to keep it below 5% because currently they have none, and this is crazy talk, right? And so, initially they're going to look at a small single-digit allocation when they move, and then they're going to go, wow, what if we've gone, 10? What if we've gone 20? And so, I'm just going ahead and jumping ahead to some maybe future state of the world where they've already reached 25, which is where, in this data set, you actually get pretty close to the optimal allocation. So, that was returns. Now we'll look at the Sharpe ratios, right? So here's our rolling 200-day Sharpe ratios. You can see we've got the gray is the 60-40, and the yellowish orange is the 70% stocks, 20% Bitcoin. You can see in general the stocks and Bitcoin portfolio is almost always looking better from a Sharpe ratio over just about every rolling period than the other one. And then we go over and crank it out. 60% stocks, 40% bonds is 0.59. Now you recall that stocks alone was 0.61. So, but bonds have been so bad over this period of time that they actually reduce the Sharpe ratio, which has not been the case in the history of the 60-40. Until recently, the 60-40 has had a better Sharpe ratio than stocks alone, but because bonds have just become a horrible thing to hold in your portfolio in the last 2-3 years, they're actually hurting your Sharpe ratio. And then you'll recall that the Bitcoin alone Sharpe ratio was like 1.02. So now you can have only 25% Bitcoin and 75% stock, and you get a better Sharpe ratio than Bitcoin alone, which with obviously less volatility, but you'll also end up with less, total return because Bitcoin alone would have returned more. But if you believe in the Sharpe ratio as this sort of balancing act between some dampening of the volatility is beneficial and you're willing to give up some amount of return, then the Sharpe ratio leads you to the conclusion that the optimal portfolio is 75 stocks, 25 Bitcoin with those two assets as your only two that you're
curious. If you did like a basket of cryptos, how would that affect your Sharpe ratio?
Good question. I think, a lot of the cryptos that we've seen over like a whole period of like 14 years, if you go back to like the cryptos that existed in 2014 and you try to hold them through this whole period, well, a lot of them have gone practically to zero and are never coming back, right? If you go to some of the early cryptos. So, from that standpoint, you're going to say, okay, this is a terrible idea, right? It looked good for a while, and then it crashed against Bitcoin, it crashed against fiat, it never returned. Now, you maybe pick, you want to pick a few that have survived, okay, let's go with Ethereum, but Ethereum hasn't existed for, maybe it started around 2014, so you could do that.
2015.
Okay, so you could probably throw Ethereum in there and see how it looks. We know, though, in general, Ethereum is sort of underperforming against Bitcoin over the long time horizon in terms of, the Ethereum price against the Bitcoin price. So yeah, I didn't do that. We're not, I think what you'll typically see though is in the early phase of some of these cryptos, they look good. They're going to show higher returns, and then when people lose interest in that crypto and move on to another one, they're going to fall off a cliff, right? And they're going to look like crap. So you'd have to kind of look at like, no, I need a portfolio where I'm somehow, picking up the newest crypto and then dropping it and moving into the next newest crypto over and over again. Maybe something like that might look good, but they are basically, you're presupposing your ability to outtrade the market, right? And to buy it low and sell it high and do that over and over again and never screw up. This is the way a crypto portfolio would look good. Otherwise, it's going to crush you because if you're holding, I don't know what, whatever cryptos were considered interesting and popular in 2014, Ethereum may be the one that's fared the best, in 2015 forward, and a lot of others have sort of died off and never come back.
Just briefly speaking to like fundamental analysis there, my Ethereum, as you say, is probably the strongest competitor. But I mean, when you think about Bitcoin potentially, I've heard we're moving more NFTs now than Ethereum, which is crazy.
Yeah, although NFTs were, have done incredibly poorly since the end of the bull market.
Yeah, they're a bad asset, but the point being that that's these are major arguments for Ethereum, and if you can do like Bitcoin virtual machine and Bitcoin that's something that's coming in 6 to 12 months. Ethereum may just totally fall apart.
Yeah, that could be, and I think what's happening now, just the divergence on Ethereum is Ethereum's got a really strong competitor called Solana. Now, Solana was beat up pretty bad in the FTX crash, but seems to actually have come back to life and actually seems to be kicking Ethereum's ass. And if you look at the fundamentals of what a smart contract chain does, Solana seems to do everything Ethereum does better and cheaper. So it doesn't seem like Ethereum's long for this world if they got to compete with Solana. But, I don't know that much about it. So somebody disagrees, feel free to disagree.
Solana's complete dog shit. Sorry.
Okay,
well, for very specific reasons. Like I actually learned a lot about Solana in the past 6 months.
Okay, why is it dog shit versus Ethereum? Just tell us briefly, because I'm curious.
It's not decentralized. Like it's completely central. It's not censorship resistant.
Well, it's not Bitcoin, but we're talking about Ethereum.
No, it's not even like Ethereum is actually like
more
arguably sufficiently decentralized. Like it's
okay.
like they've got enough stakeholders in. There's still like centralization risks, but the network itself is relatively decentralized. Whereas Solana unequivocally is not. Like not over 90% of Solana nodes are being subsidized under the table by the Solana Foundation, and that's been proven. Yeah, there's a lot of like bullshittery that's happening on Solana.
Yeah, I guess it depends on whether you feel like decentralization is even part of the value proposition of these things. I'm not sure I do that.
I mean, if it isn't, then you should just buy Amazon stock.
Fair enough. All right, well, we're about done, so let's go ahead and wrap the rest of this up. So we're going to have a little bit of on-chain data here at the end. So the Bitcoin supply continues to tighten. So this is the available supply. This graph, this all comes from the Rational Roots website. So what are we looking at here? Well, we're looking at through time, the available supply. And what's that? That's like Bitcoin sitting on exchanges and Bitcoin held by people who are known to be like fast short-term holders, people that tend to trade a lot. So what we saw is all the way through halving number 3, which is right here, the supply of Bitcoin, the available supply, has gone up, up, and up. What we've seen is halving 3 seems to have been something of an inflection point. And since then, as we approach halving 4, the available supply of Bitcoin for trade, what's sitting on exchanges is being withdrawn. The amount in the hands of short-term holders is diminishing. The amount in the hands of long-term holders is increasing. So this is an interesting trend. And when there's a supply crunch, Bitcoin tends to go to the moon. So this is an intriguing development, right? And Root has 2 models he maintains. One called the HODL model, which is just tracking the halvings, right? So they're kind of just tracking the issuance of Bitcoin and what the overall supply could be with that issuance taken into account. And he's got another one called the HODL S model where he's saying, well, it seems to be following a more steep curve than that. So what if it, so basically saying if it follows this trend, then it's extremely bullish for Bitcoin. If it even manages to follow this trend over the long term, Bitcoin is still going, up forever. So, all right. So,
Question.
Yep.
Has there ever been an on-chain analysis that pointed to a bearish potential?
yes.
I've never. Well, I've never seen.
I think the challenge is on-chain analysis is a relatively new and evolving field, but they've had to kind of maybe go back and sort of retroactively go, oh, you know what, we should have seen that, or we could have seen that. A lot of it though is people, a lot of this is paid material, right? And so you're not going to get a free sell your Bitcoin signal, right? You're going to probably have to pay somebody and get that from them, and they're going to say, hey, I don't want to go out and say this on YouTube or everywhere else because people will shoot me, but on-chain analytics now seems to indicate we've hit a top, right? So
Just that kind of discredit a lot of like the open source on-chain analysis, though. They're not willing to publish that.
This is a personal beef of mine. All through 2022, when I would sit around like meetups like this, and it was more for like cryptos and shitcoins and stuff like that. And they'd be like, "Well, the on-chain analysis says this," and like all through 2022, I'd hear from people, "On-chain analysis, on-chain analysis." I was like, guys, this discipline isn't working for you.
Well,
that was just a personal beef of mine.
So there's two parts to that. One is it is continuing to grind lower, even all through 2022. The other part is there was a piece to this which is not captured on chain, which I'm going to cover in just a minute, which you have to take along with the on-chain. You can't take the on-chain by itself, and that's the growth of paper Bitcoin. So we'll talk about that in a minute. Long-term holder supply is here in blue. So what we've seen is, and what is this? These are people that, they do some heuristics on, the transactions on the blockchain. And what they say is this individual typically just accumulates Bitcoin and doesn't sell it. And this individual has bought, a bunch more Bitcoin. And so what they're now tracking is the long-term holders now hold 76% of the Bitcoin supply, which is where this line is, which is an all-time high. You can see back here, maybe they were close, but we've now reached the all-time high. Most interesting point, though, is this is the 2016, 2017 cycle where we were last even close to this. Through the entire cycle of 2020 to 2021, we never got more than 68% of Bitcoin in the hands of the long-term holders. So one of the arguments, and this is kind of reinforced by this picture here, this is when the supply of Bitcoin, the available supply, was at its highest, and it now seems to be declining. So one of the reasons why people said, oh, Bitcoin's going over 100K in 2020, 2021, and it did not happen was because the long-term holders were not holding enough of it. So this makes a case that the 2024, 2025 cycle could be more like the 2016, 2017 cycle than the 2020, 2021 cycle, potentially.
I mean, but it seems like just from the correlation with the graph, like the amount of long-term holders is incredibly responsive to the price spikes.
Yeah, what happens is the long-term holders typically accumulate during the bear market and stack, and then when the price goes up, they sell. They distribute the Bitcoin to the short-term holders, right? When the people all come out of the woodwork and be like, oh my God, I gotta buy Bitcoin, it's just hit 60K, it's going to $1 million, the long-term holders are like selling it to them, and that's typically the way it goes, is the long-term holders are a little older, a little wiser, a little smarter, and are also sitting on life-changing money. They're like, okay, I have to sell this Bitcoin because, if I don't and it crashes, then, I'm going to be poor or not nearly as rich. If I sell a little bit now, maybe I sell 10% of my bag, then, I can go buy 10 Lambos and a yacht and live like a king forever. I don't know what it is, but something like that. So that's definitely the pattern you see, is when the price moons, the long-term holders tend to sell. Now you have to realize this is, that's 40%, 50%, 3%. So it doesn't go to zero, right?
So Doug, then do you plan to sell? Are you using Root and doing your analysis, your technical analysis, planning on following the cycle, selling at a certain point?
I do think I'd like to not have a mortgage at some point. That'd be nice. But I'm not planning to be outside of Bitcoin. I would probably say, okay, I'm going to maybe reach a certain point where I'm going to say, okay, I'm going to maybe take a little bit of this Bitcoin at what I think is a good price and eliminate all the debt that I have, so I never have to have debt again. So yeah, I will probably do something like that, but
So
but I'm going to stay long Bitcoin probably forever. So.
Right. So it's based on your fiat debt number rather than like your BTC percentage. Like I'm going to trade 10% of my stack and hold 90%.
Yeah, I don't know exactly how that'll play out. I do know that, like, given that I want to retire debt, that's it for sure. Now, outside of that, how much weight will I put into the fiat versus the thing? In general, I kind of view myself as living on Bitcoin standards, so I'm happy to basically just accrue and accumulate more Bitcoin. I'm not 100% sure that the cycles will continue forever. At some point we may reach a launching point where we just don't go down significantly anymore. So I view that as a bigger risk as, holding. I mean, I've been through two cycles now. I've crashed twice and hold on to my Bitcoin both times and never sold any ever. So this next time, maybe when I want to eliminate my debt, would be the first time that I'd consider even taking a little bit off the table.
Does he in his newsletter talk about that?
He doesn't necessarily talk that much about, this kind of thing. He's basically like, I'm providing you with data, do with what you want.
This chart here, is it from 2014 like the other ones?
No, this is just something straight off his website. So this actually goes back to 2010.
2010.
Yeah. But anyway, the point is this picture here potentially runs contrary to the notion that future Bitcoin returns may diminish. There's this idea that, Bitcoin, it was really good, and then it was like pretty good, and it was okay, and it's just going to kind of get like decent good, and eventually it's just going to be like a little better than stocks, right? So that may be the way it plays out, but this idea of the tightening of the supply is at least one argument to make that maybe we actually reached the most muted cycle we'll ever see in 2020, 2021, and then the cycles get more explosive from here, potentially. We don't know.
Actually, just a question on that. Does anyone know in the prior 4-year cycle what percentage of total coins were mined? Like total percent, like let's say we're at 93% mined right now.
Yeah, a little higher than that, but yeah, it's
Okay.
It's a calculatable number, but I don't know.
Yeah.
off the top of my head.
But I think the answer is in the very first epoch, where it was every block gave you 50 Bitcoin. Something like half of all Bitcoin were created, right? And then Bitcoin get cut in half towards 25 Bitcoin per block, and then that's a quarter of all Bitcoin, and then 12. So basically, half of all Bitcoin was in the very first halving.
What
The first halving.
It's actually easy math because you just have
Right.
like 3 times.
So you just keep having. Okay,
Right, so it's
okay, that makes
50%, then it
sense.
was 75%, and then it's 12 and a half on top of that. So that's
Okay.
what each epoch.
I was just wondering,
each,
just because you're talking about
cycle.
diminishing returns on each cycle. But if 93% of coins were mined over the last
History of Bitcoin,
15
right?
years,
95, whatever it is. Yeah.
well, then over the next 15, if there's only less than 7,
That's right.
let's call it 3. Well, then yes, there's diminishing returns.
Well,
in
you're talking
terms
about issuance. When
Yeah,
I
yeah.
say returns, I'm talking about the price movement, right?
of the price movement. But I'm saying, but then that will eventually meet supply shock.
Yeah, which is what this picture here is showing you. Is this graph here is showing you the supply of Bitcoin is basically tapering off to flat, right? And so there is a limit, right, to how much they can be. All right, we're almost done, so we got a couple more slides, and then we can talk about dinner. So this is the flip side of the prior graph. This is the short-term holder supply. So again, Bitcoin price. The short-term holders do the opposite, right? When the price moves, they buy. The long-term holders were selling. The short-term holders are buying, right? So when the price goes to the moon, the short-term holders come out of the woodwork. They're typically newbies, and they go buy Bitcoin at $50,000, $60,000, $70,000 because they think it's the greatest things to slice bread, and they never bought it before, and they wait until we're in the peak of the bull market to do their buying. So that's where the short-term holders come in, and then they get schooled, in a painful or lengthy education process that might take 4 years. So this graph shows the opposite trend, declining. What we see though is here the short-term holder supply is actually at an all-time low, right? It's grinding to negligible, right? So we're at or near an all-time low in the supply of Bitcoin held by short-term holders. Now imagine what would happen if you need to launch a bunch of new ETFs where there's going to be all these funds that need to fill up on Bitcoin at a time where there's very little Bitcoin that's available to be purchased, and there's very few short-term holders that are looking to sell it. And the long-term holders are going to say, hey, baby, I'm not selling mine, not at these prices. So it could be very impactful for the potential launch of US dollar Bitcoin spot ETFs. the bullet point here, which I think speaks to Wes's point earlier, is one of the things that the on-chain analysts missed in this past cycle, and it's something that we need to be cognizant of, is the growth of Bitcoin futures contracts outstanding, i.e. paper Bitcoin. So we're looking here at the actual blockchain and the literal coins. Futures contracts are bets on the price of Bitcoin, which you can make without owning Bitcoin. And you can even short of them without selling Bitcoin, right? So these trade on, some of the big exchanges, the Binances of the world, as well as like major U.S. exchanges like the CME, the Chicago Mercantile Exchange. And so there's another way that Bitcoin price can be sort of traded, which has nothing to do with the actual physical supply of Bitcoin. And so that represents something of an obstacle to the supply shock. If there's enough people that are pushing Bitcoin around using futures contracts, then it can mute the effect of the supply shock. And that is what we saw. I think that was certainly one of the most famous on-chain analysts, a guy named Willy Woo. That was his analysis of why he screwed up his on-chain predictions through the last bull cycle, is that he was not taking proper account of paper Bitcoin. So that's something we need to think about. Now, I think, I actually, because I'm a member of Root's website, I asked him this question actually before the session. I said, hey, Root, what do you think that your models need to be reworked to take into account paper Bitcoin? And he said, maybe, but I think the way to view paper Bitcoin and these Bitcoin futures is, first of all, it's a very expensive way for people to potentially manipulate and push the price of Bitcoin down. And he said, I think it's just best viewed as an obstacle that needs to be overcome on the path to hyper-Bitcoinization, similar to altcoins and energy FUD and U.S. government FUD, and China mining bans, and all these other things, right? Paper Bitcoin is just one more dragon we have to slay before Bitcoin takes over the world. So that was his point of view.
On the topic of paper Bitcoin, exchanges and people keeping their coins on them, that's effectively a similar situation.
Well, it is when Sam Bankman-Fried sold your Bitcoin and you think you still own it, right? So that was the big thing with FTX. You bought Bitcoin in FTX, or at least you thought you maybe you've never even bought Bitcoin. You said, here's my money, please go buy me a Bitcoin. And they said, okay, we updated your FTX account to show in your account that you own a Bitcoin. Meanwhile, we went and bought FTT token, a whole goddamn bunch of them.
Also, they were cutting checks at the Solana notes. So
Yeah,
like
actually bought Solana.
Well, no. Like what I mentioned before, that they were paying Solana nodes under the table to pump Solana. Like they were actually taking like Bitcoin, selling the Bitcoin, the customer Bitcoin, and then like paying Solana nodes under the table.
Yeah, and so that's why this guy's going to jail hopefully for a long time. I guess we won't find out the sentence in March. He's convicted in all 7 accounts in like under 4 hours by the jury. So there you go. All right, that's it. This is me. Thanks for contact information. I'm not a librarian on most platforms. I'm not a realtor. I'm actually not an investment advisor. I'm not starting a hedge fund, and I don't have anything to say.
Thank you, Don.
Food. Let's do it. Okay. I guess we can kill the stream.
Bye, Internet.